Hi, everyone. Thanks for taking some time out of your day to join us. We're excited to be speaking to you about the results of our annual Advisor WealthTech Survey. My name is Brian Scheele. I am an associate principal at Applied Marketing Science. We are a market research and consulting firm located in Boston, Massachusetts. And this year, we partnered with Orion to conduct their annual Advisor WealthTech Survey to understand key trends and opportunities advisors see in 2026 and beyond. Joining me today is Chris Shutler, Head of Strategy at Orion. How are you doing today, Chris?
I'm great. Thanks, Brian.
Good. Today, we're going to be walking through some select findings from the survey. We're going to be providing additional context about what this means for advisors and as they look at 2026 and beyond. We're going to leave room at the end for some Q&A. You can enter any questions into the chat that you might have throughout the presentation, and we'll be monitoring that throughout. Without further ado, let's jump in. In terms of our survey this year, we surveyed 571 financial advisors. Those advisors were sourced from internal Orion and Redtail databases, as well as an independent third party. The survey was conducted in December of 2025, and it was about 10 minutes in length. Right. I'm actually looking at the slides. I think we may be sharing a slightly different deck than what I have prepared, so I'm going to just reshare my slides. All right. Stephanie, there they are. All right. When we look at, we included just some quick firmographic details for you to give you a quick sense of what the characteristics were of the advisors that we talked to as part of this survey. We were excited to see a good broad cross-section of the industry, both in terms of the size of advisors and the types of firms that they were working at. I won't walk through this in great detail, but just to give you a sense, we did see a good cross-section across age, assets under management, and the type of firm advisors are working at. In terms of what Chris and I are going to talk through today, we're really going to focus on three key areas. The first is around growth and artificial intelligence. We'll include some insights around where advisors are with their AI adoption and where they're looking to go. Next, we'll talk about technology investment and the current pain points that advisors have. And last, we'll talk about some outsourcing and key wealth management trends, including some information around different asset classes like alternative assets. To dive into the results a little bit, we're going to start off with growth and artificial intelligence. We started off the survey by asking advisors, what's their top strategic area of focus in 2026? Where are they putting their effort? And what we see is that advisors are really focused on integrating and optimizing their technology and data usage across the firm, as well as utilizing AI as strategic focuses of this year. This is really important because it tells us that advisors are shifting from simply adding tools to making better use of the existing technology that they have. And they really view AI as a critical enabler of some of the key initiatives that they're focused on in 2026. You're going to continue to see AI as a common theme throughout this presentation. But Chris, I know this was one of the very interesting data points that we saw early on in the survey.
Yeah, and I would say, Brian, so the top two priorities here, data and AI, I think really point to the fact that AI is only as good as the data underneath it. Before firms think about investing in AI tools, they really need to solve the data foundation problem first and foremost. So think about consolidating fragmented data into a single unified layer, ensuring that data is clean and normalized, connecting reliably across both your in-house systems and third-party sources. I also think it's interesting as we looked at some of the crosstab results here, there was more focus on this item number one than optimizing integrations and data for larger firms as well as for Orion clients. And then the only other thing I'd say on the third bullet, expanding services to attract and retain high net worth clients. What are some of those expanded services? So think of like tax management, think of deeper financial planning tools, think of access to alts. So
yeah, and we'll touch on that later in the presentation. And really, where are advisors focused on in meeting those high net worth client needs? We also asked advisors the question around force multipliers. So force multipliers, for those of you who aren't familiar with the term, is something that dramatically increases your effectiveness as an advisor. Again, unsurprisingly, if you're staying up to date with the news, we see that AI is something that advisors are looking to really amplify their effectiveness. Along with that, it's streamlined workflows, process optimization, and integrated technology. These things allow firms to grow faster without adding additional time, cost, or complexity. I'll also note that this is an interesting trend because it's not just in the short term. In another question that we don't have represented here, we saw that advisors really are thinking about the future and see the successful advisor of 2030 as someone who can blend and build trust in an AI age. AI is continuing to affect this industry, and I know you at Orion are continuing to work on helping advisors use AI.
Yeah, no, absolutely, Brian. I just say on this slide from a practical standpoint, before investing in AI, particularly point solutions, I would encourage you to just take a step back and map out your workflows as a firm more holistically so that you can understand, if I do plug in tool XYZ, how does the rest of the process change as a result of that, just so that you kind of understand what you're getting into and that you're going to get the ROI out of it that you expect.
Yep, absolutely. Looking into 2026, we asked advisors which of the following trends do they believe will have the greatest impact on advisor success. Here we see that AI again bubbles up to the top. It's going to be a top trend. Advisors know that it's coming and are working on implementing it into their practice. Interesting though, on this slide, we see that generational wealth transfer and next-gen client management is right up there neck and neck with AI. This is something that generated a lot of buzz over the last couple of years, and it was interesting to see that it's a sticky trend that advisors are seeing. They're looking for ways to make sure that they're building those relationships in really setting themselves up as well as their clients up for success with the next generation when that wealth transfer does happen.
Yeah, and on that point, Brian, so generational wealth transfer and next gen coming in number 2 here on the list. I mean, it's definitely something clients are thinking a lot about. So think about, like, have you mapped out your client's full household, like identifying their heirs, the beneficiaries, family dynamics? Have you invited your client's adult children to an annual review? Do you offer estate planning? So a lot of different things to think about when it comes to next gen and generational wealth transfer. And I think more broadly, I think the takeaway from this slide is advisors are placing a lot of emphasis on both operational efficiency and relationship continuity.
Absolutely. Where we see some tension though come up is it seems that advisors have a lot of aspirations for AI, and Chris, you touched on this earlier. There's a lot of goals they have to integrating AI successfully in their practice. It'll allow them to work more efficiently and ultimately meet their client needs in a better way. Yet we see that there's a gap between what advisors are doing right now and what they want AI to do in the future. We asked advisors where they are in terms of AI maturity. Right now, most advisors, 63% of them are using AI for simple productivity tasks, like helping them write emails or take notes on calls. We see almost a quarter aren't using AI at all. But the more advanced AI use cases like agentic tools and cross-system AI integration is fairly limited. A potential reason for this is advisors are noting that there's some barriers to using AI. They're concerned around accuracy and transparency with their clients. They're concerned about making sure that they truly understand the value and are seeing the ROI of new AI tools. All of this points to the idea that advisors have big goals with incorporating AI into their practice, but they may need some help in identifying how to best use AI and make sure that they're getting that ROI on these investments.
Yeah, and so when I thought about what I wanted to talk about with this slide, I reached out to one of my colleagues there in college who runs platform unification and AI strategy at Orion. And I asked, what action she would recommend for firms that are still in the two buckets on the left to kind of move up the AI curve. She recommended that firms map out key workflows. So answering questions like, what are the most repetitive time-consuming tasks? Where do errors most typically happen? What client-facing work takes longer than is ideal? And if you answer those three questions, that can help shape kind of where to focus first. So I think it's really about starting to experiment. And I think picking one low-risk example and running a 30-day experiment would be something that she would recommend.
Mm-hmm. Yeah, that's great advice. We'll touch a little bit more on technology in some coming slides, but before we went there, I do want to just bring up one of the key items that we've tracked across the different surveys is advisor growth. And what we saw is that advisors grew steadily in terms of organic asset growth rate in 2025. But when we compared the results of non-Orion advisors compared to Orion advisors, we saw that Orion advisors were growing at a much faster rate, close to 40% more quickly than non-Orion firms. Chris, I know this was something that we were excited to see, and obviously is a main goal of what you're after at Orion.
Yeah, I mean, just to add a little more meat on the bone here. So Orion advisors in the survey grew about 3 percentage points faster than non-Orion advisors in 2025. And I do think it's important to note that when looking at that growth, we sliced and diced the data in a bunch of different ways. So we looked at advisors using different types of Orion products or capabilities. We looked at averages and medians. We looked at different channels, and in most, if not all cases, Orion advisors were growing faster. So, why is that? I think there's probably some of it that can be attributed to Orion and kind of the breadth and depth of our ecosystem and the productivity that we're able to help advisors with. I think some of it is also just being in the right place in the market. We are, I think, privileged as a company to serve some of the industry's most forward-thinking firms, both large and small. And I think that benefits us not only from an M&A standpoint, an inorganic standpoint, but also from an organic growth standpoint, which is what's being highlighted here.
Yeah, absolutely. Great. Jumping a bit deeper into technology investment and pain points, we really wanted to understand, are advisors shifting their priorities to meet some of these new pain points as AI gets integrated into their systems? One of the key questions, again, that we've asked year over year is, how do you think your firm's investment in technology in the next year will change? Do you expect it'll increase, decrease, or stay about the same? We saw that advisors are continuing to invest in technology. They're recognizing the importance of technology and their success as a modern advisor and their ability to meet a wide variety of client needs. And we don't see a slowdown when we look year over year at the rate at which advisors are investing in technology. The average increase is 19%, which is consistent with the 2025 survey, indicating that investment isn't going to slow down in the short term. And advisors still believe that investing in technology is a key strategic priority of their firm.
Yeah, and that's certainly what we see as well at Orion, Ryan. And just stepping back for some perspective on what I typically hear in the marketplace, the average RIA, of course it varies, but they spend on average about 4 to 6% of their revenue on technology. The average broker dealer is typically a little bit higher than that, but again with a wide range.
Mm-hmm. One of the key, again, points of tension is, well, we're continuing to invest in technology, but are we utilizing all of that investment? And what we see is there's still opportunity for improvement in terms of both utilization of technology and integration. On average, advisors are only utilizing about 60% of their tech stack, and just over half of that tech stack is integrated. We haven't seen much change in this year over year, and it really does highlight an opportunity for firms to get more value out of the technology they already have. And again, making sure that their technology investment is smart and it's intentional. It's focused on answering some of those questions that you raised a little bit earlier in the presentation, Chris.
Yeah, and I mean, I do think AI will ultimately help a lot with utilization over the coming years, since you're increasingly going to be accessing the tools that you're using through natural language. So it just makes it that much easier, rather than having to learn kind of the ins and outs of a bunch of disparate pieces of technology. What the 54% on the right means to me is that integration needs to improve. There's all this investment being poured into technology, but in my mind, this really reinforces the importance of kind of doing an audit of the technology that you already have, so that you understand how it's being utilized, whether it's being utilized as intended, and then taking the time up front to build that solid data foundation, as I alluded to earlier. Once you do that, I think you should be able to layer on AI on top and make it a more integrated experience for the advisor, and certainly easier to learn and use.
Definitely, and we see that integration is so important in making sure that you're getting the full usage out of your different tools, and it's not we're just buying tools for buying tools' sake.
Right.
When we think about, or when we ask advisors where they're looking to technology to improve their effectiveness, they really identify a lot of the areas that you're talking about, Chris. They think about things like reducing manual work and streamlining operations. They think about freeing up time for their clients, right? We've asked this question in a variety of ways across the years, and oftentimes where advisors are looking to is how can technology save me time so I can provide more of that value add to my clients. Other key benefits are things like personalization at scale and better decision making. But the primary focus that advisors are looking to technology to help solve is to give them time back to focus on what their client needs actually are, in really providing the clients value for the relationships that they're building with them.
Yeah, I think that 67% wanting to eliminate manual work. I mean, if you look at the gap between this and the other answers, it's pretty clear what advisors want out of their technology broadly, as well as the AI. And it's really, I think, to get rid of all the annoying stuff they don't want to deal with more than anything else. And that goes hand in hand with the number 2 answer. They want to have more time to help current clients, and in some cases to prospect.
Yeah, absolutely. Yeah, I think one of the key things that we see in our research across industries is how do we take some of the things that are very repetitive, that we have to do every day, that we're not really, that aren't adding much value, but they're necessary, and how can we layer in technology to help solve those challenges?
Totally.
The last question that we asked advisors around technology as part of this section was, where are their top pain points? Even as advisors continue to invest in technology, they have pain points related to disconnected systems that don't talk to each other. You can see that is far and away the most challenging thing that they're looking to deal with. or that they need help with solving related to technology. Other key areas that are pain points are insufficient training on their systems and rising costs related to their perceived value. It underscores the challenge of making sure that their technology works together and it's delivering value to their advisors. These trends have remained consistent year over year. And when you think about all of this, it's really underscores the need and the opportunity in the market to provide better solutions to help advisors address some of these challenges and again, give them time back to focus on clients.
Yeah, here the fact that 51% of advisors put disconnected systems in their top two pain points really is not shocking. Ever since I've started doing survey work over the years, probably a decade ago, disconnected tech has always been one of, if not the biggest issues that advisors have. The number one, or rather, the number two answer here, I think, is one of the more underrated findings of the survey. More than a third of advisors said that insufficient training is one of their top pain points, and that is an area that I do think AI will help with. But I do think it brings to the forefront for advisory firms as they consider adding technology, making sure that there is a plan in place to train on that technology and follow up by measuring the usage.
Mm-hmm. Yeah, it's a continual process. It's not as simple as just saying, "Hey, we have a great new AI tool. Now all of our problems are solved." We need to make sure that our team is trained on how to use them and how to get the most value out of the tools that we're investing in. The last section of data that we're going to talk through today is looking at outsourcing and wealth management. So again, with all of the challenges and all of the priorities that advisors have, it's not surprising to see that many are looking to third-party solutions to extend their capabilities and reduce some of the complexity of meeting the needs of a modern investor and a modern client. When we asked respondents or advisors about where they're using third-party solutions to help them meet key functions of their business, we saw that many are using a wide variety of third-party solutions, or they're planning to invest in new solutions in the future. We asked about a number of different advisor functions here. We pulled out just the top or 4 interesting functions that we thought were surprising or related to many of the problems that advisors are facing today. Advisors are looking to build on momentum with current investments and future plans to expand for tax optimization services, separately managed accounts, unified managed household platforms, and direct indexing platforms. The bars on the left-hand side of the chart, that blue bar represents the percentage of advisors that are currently utilizing these platforms. The light blue bar and the gray bar indicate advisors that are either currently using and planning to expand the use of, or not using currently but planning to adopt. When we think about this whole set of bars across these different types of solutions, really in most cases, close to 2/3, if not more, of advisors are planning to use some sort of third-party solution for these core functions to help ensure that they're meeting client needs.
Yeah, Brian, when I look at this, I look at mainly the 2 bars in the middle, so the light blue and the gray, just as those are the individuals that plan on increasing usage, or if they're not using today, beginning to use these different types of personalized solutions. So big opportunity for a lot of these different things, tax optimization, direct indexing, et cetera, in the years ahead.
To double click on a couple of the things that we've talked about so far, one of the areas that we asked advisors for their opinions on was on client household management solutions. Advisors see a lot of value in being able to manage an entire client's household rather than just individual accounts. So on the left-hand side of this slide, we see that 84% of advisors say that the ability to manage their client's entire household, including both taxable and non-taxable accounts, is valuable to them. Why is that? That's where the chart on the right comes in. We see that advisors believe this will allow them to provide more holistic engagement with clients in their investments, to provide better tax efficiency, stronger retention of those high net worth families that we alluded to earlier on, and a greater share of wallet with their clients. These are all key in ensuring that they're building traction and trust with their current clients, but also the future clients for those high net worth families or families that have some generational wealth transfer happening in the near future.
And Brian mentioned the 84% on the left, but then diving a little bit deeper right below that, essentially half of the advisors say that managing portfolios at the household level would be a significant value add for them, which I think is an interesting finding. On the right, around kind of expected outcomes of household management, I think it makes a lot of sense. The number one answer is that advisors would expect more holistic, deeper engagement with clients. When you think of everything that's coordinated at the household level, you have a view of more accounts and you're taking actions with the bigger picture in mind.
Mm-hmm. Yeah, I think the chart on the right also, if you look at those dark blue bars at the bottom, 9 and 10, or just above that, believe that there is value in having client household management capabilities. So most advisors are thinking about this and potentially looking to incorporate it into their business in the future.
Yep.
The last couple of slides that we'll go through today cover a new topic that we added in 2026, really alternative investments. Given that this was a trending area of the market, we wanted to hear from advisors about how they plan to incorporate this into their client portfolios. We asked them, by the end of 2026, what percentage of your client portfolios do you expect to have allocated to alternative assets? And what we saw was the vast majority of clients or of advisors are planning to use alternatives in some sort of way in their client portfolios, especially those higher net worth clients. We also see that the percentage or the average percentage expected to be allocated to alternative investments on the right-hand side of this slide increases as the total client portfolio value increases. So for higher net worth clients, advisors are expecting to incorporate more alternative assets into their portfolio. It shows that alternatives are moving from more niche to increasingly mainstream. And it's important for advisors to stay up to date on this asset class as future clients may become more familiar with it. They may look and ask advisors about including this as part of their portfolio. So some interesting changes happening in the market here.
Yeah, and just more recent, more topical, Brian. I mean, there have been a lot of headlines in recent weeks around concerns in the private credit space with default rates, particularly related to some of the AI disruption in the software sector. Certain funds altering investor redemption rights, marking down investments, cutting dividends, et cetera. I think the key issue here really is around investor trust and confidence in, if we're talking about semi-liquid structures. It's really too early, I think, to say much definitively, but I do think there's going to be a lot of focus here in the coming months around diligence of these funds. And the recent events, I think, absolutely highlight the importance of understanding your, as an end investor, your tolerance for illiquidity, because I think the reality is that even some of the semi-liquid funds can become less liquid in times of more stressful markets, which we've started to see.
Mm-hmm. Yeah, and I see a question in the chat from Scott around the definition of alts. The examples we gave included private equity, private credit, real estate assets, a wide variety of different alternatives were included in this definition. The last slide that we'll talk about really dives into what you alluded to, Chris. There's excitement with alternative assets and in clients, or being able to incorporate these into client portfolios, but it's not going to be without challenges. Some of the top challenges that advisors see on the left-hand side include high fees, client hesitation with perceived risk or lack of transparency with alternatives, and finding the right opportunities for their clients. So there's going to be some challenges, but we also heard from advisors that they're looking to technology to help them incorporate alternative assets into their business. They're looking for technology to help simplify onboarding, improve portfolio modeling, and integrate performance reporting to allow them to help solve some of these challenges or some of these barriers that they may run into when it comes to incorporating alternative assets into their client portfolios.
On the left here, I think the challenges are remarkably evenly distributed. So there's no kind of single blocker. It's kind of a multi-front problem, which makes it trickier in some ways to solve. Regarding fees on the left, at the top answer, I get it. There's a lot of they are higher than buying an ETF in most cases, or a mutual fund. So I think communication around alts with your clients is really critical. Being able to illustrate the diversification benefits of certain asset classes in the context of a broader portfolio. Focusing on net returns, not gross. Taking a hard look at consistency of the manager's track record. As you may know, in alternatives, there tends to be greater kind of persistence of returns, meaning that managers that are in a certain quartile in one vintage tend to remain in that same quartile or that same range in subsequent vintages. And then on the right, you can see some of the ways that advisors feel technology can help with adoption of alternatives. So advisors want simpler onboarding. They want better modeling of the way that alts can impact their portfolio risk and return. And they want integrated reporting with alts kind of sitting right alongside traditional asset classes.
Mm-hmm. Those are all of the slides that we have today. We do have some time at the end for some Q&A. Chris, the first question that I see is around, does Orion offer integration specialists to assist with optimizing a firm's use of applications, including the rollout of Query Studios and Denali?
I'm sorry, do we offer, what was the first part of the question, Brian? I apologize. I don't have it in front of me. Integration specialists. We have onboarding specialists, integration specialists. That's not a specific role at Orion, but I do think that we can certainly help advisors with integrations of various types. So that would definitely be something that we can help with.
Great. Those are all of the questions that I see so far. The other questions are around whether this will be recorded and if we can share slides. Chris, I believe that's the plan, but I'll look to you to confirm that.
Yeah, I think that's the plan at this point, Brian. Yep.
Great. Awesome.
I would also, Brian, sorry, I would also note that these slides are available as part of our full survey, which we did publish a press release a few weeks back. And so if you want access to the full survey results, including these slides, that's all available if you check out that press release.
Great. Well, those are all of the questions that I see. That's what we have to cover today. Chris, any final thoughts before we wrap up here?
I don't think so. It's been a pleasure working with you on this, and appreciate everybody's time.
Awesome. Thanks, everyone.
Thank you.